All right, this video is going to be about the chapter on taxes. So, taxes are going to be your largest expense in your life, especially if your life goes well. Taxes are by far more than my housing expense, food expense, rent, mortgage, etc., etc. Very easily, taxes can consume 20, 30, 40% of all your income. So certainly taxes are incredibly important to cover. I'm going to just go over some of the basic taxation philosophies. If I went every single line item on the PowerPoint, I would probably fall asleep halfway through it. Taxes certainly are incredibly boring, but they're certainly critical. And I need you guys to kind of understand some of the overall philosophies. A couple of things. What are taxes? Taxes are anything that the government requires you to pay for the operation of the government. So we look at federal taxes, excise taxes, sales taxes, property taxes, use taxes, airport bond taxes, water bond taxes. So there's certainly a plethora of taxes that are levied by the government to produce income for the government so that they can then in turn provide services for the general welfare of society. And within that, there's always some people that believe more needs to be spent and some people believe less needs to be spent. Some people want to spend a lot on national defense. Some people want to spend almost nothing on national defense. Some people want to spend lots of money in charity in other nations and have the U.S. go in and help individuals starving. Other people believe we should help governments overthrow other governments that are starving their people. And so there's certainly a lot of arguments about what is the good and bad use of taxes. In fact, that would probably be a heck of a lot more interesting lecture than just general tax philosophy, but we're not going to be going into that. So what are some of the philosophies of taxing? So how are we going to get the money? There's the benefits received philosophy. Benefits received means the individuals who receive the benefits from the government should pay for them. So some of those are like trash pickup, right? If you own a house and you have trash picked up at your house, you pay to have the trash, and there's taxes associated with that. One of the most clear and obvious ones is bonds raised to expand airports. And if you looked at the general area, like say Los Angeles or Denver or any place with a major metropolitan area, and they want to do an airport expansion of $1 billion, there is no way that the city would approve paying $1 billion in bonds because the citizenry doesn't use the airport that much. Certainly they benefit jobs, tourism, et cetera, but they don't want to be on the hook for that $1 billion. And so we go a benefits received philosophy, and so the government taxes people who fly by an airport landing fee tax. If you look at your next airline ticket, you know, it says how much the ticket was, there's tax, there's 9/11 tax, and then typically there's what's called an airport use fee or an airport landing fee. And that fee is anywhere from $2.50 to $5 charged to every single person that lands at that airport. And if you're landing at the airport, you're receiving the benefits of that airport. And then those $4 fees, $2.50 fees are then collected, and they pay off the bonds that were used to expand the airport. Some of the other benefits received philosophies would be the national parks. If you want to go into a national park or even a regional park, there's a fee associated with it. Certainly doesn't cover all the expenses. But like our regional park locally is $5 on the weekends and $2 during the week. If I want to go enjoy that park and all the great amenities that it has, I pay $5. And so that's the use. The other philosophy is the ability to pay philosophy. So in other words, we don't care who's getting the benefit. What we want to find are the individuals who have the money and that they can pay for it. So therefore, we're going to tax those individuals that have that money. That is basically our federal tax system and our state tax system that goes by income. Doesn't matter what you do with that income. And the more money you make, the more you pay in taxes. We have in both the state system and federal system what is called a progressive tax system. Progressive means the more you make, the more you pay. And so if we look at, let's say, very simple numbers, these certainly aren't the numbers that are out there right now. Let's say that income from $0 to $10,000 is taxed at 0%. And then we might end up with 10,001 to 25,000 is taxed at 15%. 25,000 to 75,000, we're going to tax at 20%. And we're going to say $75,001 plus is taxed at a rate of 40%. So this is what's called a progressive tax system. The more and more money I make, the higher and higher my taxes go. These individual brackets are what we call your marginal tax rate. So if I make $10,000, I'm taxed at 0. If I make $10,001, I am not taxed all $10,001 at 15% and then have to turn around and pay $1,500. No, these end up being brackets. So if I make $20,000, the first $10,000 is taxed at 0. So I subtract out $10,000, and I'm going to be taxed at 0 for that. That leaves me another $10,000. The dollars that you make between $10,000 and $25,000 are taxed at 15%, which means this second $10,000 that I made, I'm taxed at 15%. This is what's called your marginal tax rate. Every time you make another dollar, how much do I pay? So $10,000 times 15% gets me $1,500. So the first $10,000 I get taxed 0. The second $10,000 I get taxed $1,500. My total tax bill is $1,500. So now we get into the other question, which is called an average tax rate. Now, marginal taxes mean I make one more dollar, how much do I pay in taxes? So if I made $20,001, I'm taxed at 15%. My average tax is I take my total taxes, $1,500, divided by 20,000 to get my average tax rate. So we're going to take 1,500 divided by $20,000 equals 7.5%. So my average tax rate for this person is 7.5%. Under this progressive system, my marginal tax rate, which means what I'm paying right now on the next dollar, on my 20,000th and first dollar, is 15%. When we are making decisions, do I want to work more? How much money do I keep after taxes? And I'm trying to figure, do I want to work an extra shift for $100? I do not look at my average tax rate and say, if I work and get another $100, then I only have to pay $7.50 in taxes. That's not true. That is my average tax rate, but my marginal tax rate's 15%. If I made $20,100, that extra $100 would fall down here, and I would pay an extra 15% on that, so my taxes would go up by $15 or 15%. So when we're making decisions on how much money we're going to have left over, we are looking at our marginal tax rates. The same thing in the higher brackets up here. If I am making $70,000, then I am in the marginal tax rate of 20%. And I've paid 20% on everything from $25,001 up to $70,000 where I'm at right now. If I'm making $70,000 right now and my boss comes in and says, hey, got a great deal for you, you've done such a great job, we're giving you a raise. We're going to give you a raise to $80,000. So $80,000 is in this highest bracket. You do not take $80,000 and multiply that entire amount by 0.4 to come up to how much they have to pay in taxes. That's not what we do. What we're going to do is we're going to calculate the first 10 at 0. So even if you're making $1 million, your first 10,000 is at 0. Then the next 15 is going to be taxed at 15%. The next 50,000 is at 20, and then everything over 75,000 is taxed at 40. So if I got a $10,000 raise, what would my taxes be on my $10,000? First, half of it falls under 20%. So I would have $5,000 at 20% because it falls within this bracket, and then another $5,000 here. So I got $5,000 at 40%. So my taxes here, 20% of $5,000 is $1,000, and 40% of $5,000 is $2,000. So I am going to end up paying $3,000 in taxes out of my $10,000 raise. All right. So hopefully that's a good adjustment there, or understanding of a progressive tax system. One of the other tax systems is what's called a flat tax system. This got a lot of popularity for a couple reasons. One, the tax code is incredibly complex, and an awful lot of people think it's unfair, and actually the tax system is a detriment to the overall society. You look at the number of accountants and lawyers and the amount of time that people take managing their tax liability instead of working harder, making more money. A lot of people think that needs an overhaul. Make sure to watch the one video that's separate from this called the Laffer Curve that gets into some taxation philosophy and some of the ins and outs of those items. So the flat tax system says instead of having that progressive system with a whole ton of different deductions, like you get to do deductions for interest on your house, taxes on your house, taxes if you buy a new car, charity deductions, medical deductions over a certain amount, moving expenses. There's just a myriad of things. In fact, my last tax forms, when I submitted them in, were about that thick because there was so much going on. I got a couple side businesses that I work with. And it is a hassle to track all that. So a flat tax system, what it says is, instead of all these different rates, let's do this. you take your income, you subtract from it $40,000 that's taxed at 0, and then everything over $40,000 we are going to multiply by 20%. Some systems have it at 14%, 22%, but if you made $100,000, you subtract 40, which gets us $60,000. We multiply that by 0.2, and we end up with a tax of $12,000 bucks. And that's it. That's all we have to do. One large deduction that's going to encompass pretty much all our low wage earners that aren't going to have to pay taxes, and a tax rate which is very straightforward, easy to do. In fact, some of the biggest proponents, what they say, instead of having to fill out all these tax forms and pull up all this stuff again and again and again, you can just do this on a simple postcard. How much money do I make? I subtract it by 40,000, and then I get how much I got left over, 60. I multiply it by 0.2. There's my taxes, send in my check, and I'm done. There are a couple other flat tax systems which are kind of modified, which are to try to protect some of the deductions that people like the most. Some of the deductions that people really, really like to stick with, and it certainly saves me a decent amount of money, although this system would probably work better for me, is interest on your home loan is deductible. Property taxes are deductible. Charitable contributions are deductible. So under this system, you do not get a break for donating to charity. And so a lot of charities are concerned that that would impact them. So one of the other systems that's kind of a modified flat tax, and there's several different ways to do this, but this is kind of the general idea. Certainly the government needs to raise revenue, and so we're going to set up a system that is revenue neutral. Instead of subtracting $40,000 here, we subtract only $25,000, say leaving us $75,000, and then we allow people to say take 2 deductions, and they get to pick 2 deductions from a list of like 10. So I might pick charitable deductions. Maybe I've given $10,000 to charity, and I have $10,000 in property taxes, right? Someone else might pick for their 2 deductions from an approved deduction list. They might pick home interest expense of $5,000, and then some other deduction that they have. Maybe they had lots and lots of medical expenses, and so they've got $10,000 in medical expenses, getting them to $60,000 that's taxable times 0.2, and we're back to $12,000. Okay? That's kind of the modified flat system. Most people who are big proponents of the flat taxes do not want to give people a couple deductions here, because Congress being Congress and trying to buy votes, 2 deductions becomes 3, becomes 4, becomes 7, and next thing you know, they start playing around with the other numbers because they're trying to make it revenue neutral. So now you get to deduct 5 of these, but the discount, the first $15,000 instead of 25, and it just, we will end up back in the same place we are. And so I certainly am a big proponent of a flat tax, only because it's simple, easy to do. The amount of money people would save not having to do taxes and not having to do that hassle is to just come up with a very simple, subtract about 40,000, come up with whatever that number is. So I got $60,000 left over, and multiply that by 20%, and we got revenue. All right, so that's the flat tax system. All right, so now we're going to continue on. We've gone over what's called a progressive tax system, which the more and more you make, the higher and higher your tax rate goes. We've gone over a flat tax system, which says, let's take your income, give you one big write-off, $40,000, $25,000, and then tax the rest at one rate. There's also, you'll hear an awful lot of times what's called a regressive tax. In other words, a regressive tax is a tax that impacts people with lower income than people with higher income. And there's some misunderstandings about what a regressive tax really is. A regressive tax means that a person with a lower income spends a higher percentage of their income on that tax. Not that the poor person pays more actual dollars in taxes. In fact, there's actually only two taxes in which people who tend to be poor pay more than people who are wealthy. And those two taxes are cigarette taxes, because individuals with lower income smoke a lot more, and so they pay more taxes. And the other one is the lottery, which I believe the California lottery is just a tax. And so individuals with less money tend to play the lottery a lot more than people with money, and so therefore a large percentage of those lottery dollars that people are putting down are going back to schools or other institutions. So it's basically a taxation on the citizenry. All lotteries are. And so what exactly is a regressive tax? Because you hear all the time how this tax is regressive or horrible. And so we're going to look at a tax that is regressive, and that is gasoline taxes. And so what we're going to do is we're going to take two people. One person makes $200,000 a year, and the other person makes $50,000 a year. All right? So the person with $200,000 a year isn't going to be impacted all that much by gasoline costs. It's certainly a concern, like all costs, but not nearly as much. And so there's a very good chance that they will buy an automobile that gets a lot worse gas mileage. So let's give this person here a horrible gas mileage vehicle. We'll give him a Hummer. And a Hummer gets about 8 miles to the gallon. And the person who is here at $50,000, we'll give them a nice mid-range compact car, like the new Chevy Malibus or something like that. Their redesigns are really nice. And so this person will give a Malibu. And a Malibu is going to get about 24 miles to the gallon. Now, to keep this equal, both these people are going to drive the same amount of miles. And so we're going to say that each person drives 25,000 miles. Now comes the question, how much money do they spend in gasoline and gasoline taxes? Well, to figure out how many gallons of gas that they're going to buy, I'm going to take 8 divided into 25,000, and that gives me that the person owning the Hummer is going to buy 3,125 gallons of gas. If I take 24 miles per gallon into 25,000 miles driven, we're going to get this person over here is going to buy 1,042 gallons of gasoline. To keep things really simple, what I'm going to do is assume that state, federal, and local taxes are $1 per gallon. So I'm going to multiply these by $1, which means the person with the Hummer spends $3,125 in gasoline taxes. I'm going to multiply this by $1. And the person who owns the Malibu is paying $1,042 $42 a year in gasoline taxes. Certainly, the person over here making $200,000 is spending almost 3 times as much as this person over here. However, the income difference here is 4 times. And so what we're going to then do, figure out what is the tax burden to this individual. In my opinion, I think the tax burden to this individual is $3,125. And the tax burden over here is $1,042. Certainly some of this could be justified. This person should pay more taxes to help repair the roads. If they're driving a Hummer that's a lot heavier, that gets a lot less miles to the gallon, it's going to be a lot tougher on the roads at the same time. But what I'm going to do is I'm going to divide both of these by their income. So I'm going to divide 3,125 by 200,000, which is the income. I'm going to divide the 1,042 by $50,000. So what we end up getting here is 200,000 into 3,125 gets us 1.56%, which means 1.56% of this person's income is spent in taxes. If we divide this over here, 50,000 into 1,042, we get 2.8%. Sorry, 2.08%. So this individual spends 2.08% of their income in gasoline taxes. And so because the person with less money is paying more as a percentage of their income than the person with more money is paying, this is considered a regressive tax. All right? A regressive tax does not mean that the poor or individuals with less money pay more. What it means is based solely when we divide back into income. All right. And that's the end of regressive taxes. I only got one more thing that I really want to cover here on taxes. And one of those things is being quote-unquote scared of the IRS. Now, certainly the IRS has lots and lots of power. And if all of us in the U.S. decided not to spend or not to give a dime in taxes, there's nothing the IRS could do about it. The problem is we all agree not to pay taxes, and then everybody pays taxes but me, and then I'm in jail for 45 years. So the IRS has some big hammers that they can use for compliance. And so even if you cannot pay the taxes, you still file your taxes and then just add in a handwritten note that says, I know I owe $6,000. I don't have $6,000. I'll send you $500 a month each month for a year until it's paid off. What will happen is that goes to the IRS. They will take it and they'll set it aside. They got so much going on in tax season, they can barely keep up with anything. And so that will sit there for 4 months, 5 months, 6 months, 9 months. And in that time period, you need to keep sending checks to the IRS. So when someone actually gets around to it, they'll look at it and go, oh, well, they got 4 or 5 months to go. That's fine. Or maybe you came up with some payment plan. You owed $6,000, $7,000 of $1,000 a month. And next thing you know, you got it paid off before they even have tracked you back down. You will end up paying interest on that, but at least you're not going to pay a whole ton of penalties. And if you do not file your tax forms, it is automatically considered fraud. And so you got to file them. The other thing that I would add into that also is I think you should be very aggressive on taking deductions that you think you deserve. Now, it kind of has to pass the smell test. So if you're looking at kind of a gray area deduction, what you want to do is say, okay, if I'm in tax court and I'm explaining to the judge what this is about, and I can do it with a straight face, I go ahead and take the deduction. Maybe I end up, the IRS throws it out, and I end up having to pay the taxes on that. Well, you know what? I would have to pay the taxes anyways. And unless it's a really large item, even the interest isn't going to add up to that much. However, if you take deductions that clearly do not pass a smell test, you could end up in a situation where the IRS is saying you're trying to commit fraud. And you're taking deductions you know you cannot take, but you took them anyways. That's where the big penalties come in, and that's where jail time comes in. So I'll give you one of the simple ones that I took that ended up getting disallowed. I do some financial advising and used to do financial advising, and so I got consumer reports. And I wrote off consumer reports. In my opinion, Consumer Reports is a scholarly journal. They do not take advertising. They do lots of research. They give tons of feedback. They've got surveys of tens of thousands of people on all these products. And so, in my opinion, it's a journal. It fits all the standards that a standard finance journal would that'd be published. However, it comes out monthly, and it's in color, and it's easy to read compared to most finance journals, which put you to sleep. And so I went ahead and wrote it off. And it got flagged because there were also a couple other items. And they called me up and said, in fact, they actually did do it on a phone call, and said, hey, you know what? We don't agree with these 2 or 3 items that you took as deductions. You know, you need to pay this. And I said, well, wait a minute. I don't think that's true. And I gave the reasoning. Now, I could sit and legitimately explain why I think Consumer Reports is a journal. I could not sit and say, I got the National Enquirer. I'm writing it off because they got really funny cartoons that have to deal with finance, and then I use some of those cartoons in mailers, so therefore I'm writing off the Enquirer. That does not pass the smell test. I'm probably going to lose. I was in a disagreement here with the IRS. It was on 3 items, and then it becomes a negotiation at the same time. The IRS is a money-generating institution. Their audit department is a money-generating department. If they think they can get a lot of money out of you in penalties and fees, and they'll threaten you with jail time, they'll go after you. But if they don't think there's a lot of money there, they're more than willing to settle. And so when I looked at the 3 items, one of them was the Consumer Reports, I said, well, I'll tell you what. I'll pay the tax on the Consumer Reports. It didn't add up to much, so I really wasn't giving much away. And I'll pay the tax on this other small item, but this large item over here, I'm willing to go to tax court on. And they said, okay, well, you know, there's an audit penalty of $250 plus interest plus this. And I go, no. Well, then I'll go to court on all 3 of them. You know, if you want $185 out of me for taxes on these items, I'll pay the $185. If you want that plus penalties plus interest, I'm going to take all 3 of these things and go to tax court. And the IRS person looks at it and going, they're either going to win or they're going to lose. Their upside is $500. Their downside is 0. They don't want to go waste and prepare time and go to court and go through all this type of stuff for $500. Why? Because they've got a pile of audits of people that owe them $20, $30, $60, $100,000. They're going to go after that person. So very simply over the phone, negotiated it out, wrote them a check for $185, and I'm done with it. And by being aggressive, even though I got quote-unquote caught on that one, if I was conservative, I would have paid that tax to begin with. But all the other years that have gone by, I've gotten a lot of gray area deductions, which I think are legit, and I can make a very legitimate argument of why they are tax deductible. I never venture into an area that I think doesn't pass a smell test and on its face seems fraudulent. Because if they find fraud, I really don't feel like spending $20,000, $30,000 in penalties and maybe a couple of months in jail. That's not right. So in the gray area, be aggressive. in the ungray area, stay away from it. Okay. Thank you very much for your time.